Okay, welcome to Module 8, Accounting 503. This is on losses and bad debts. So let's start with a few ground rules, some items that frankly we've already covered. So rule number 1, personal losses are not deductible. I'm going to walk back from that a little bit tonight. Business and investment losses generally are deductible, and that remains true. And worthless securities we treat as if they are worthless on the last day of the year. Okay. So one of the items that we've discussed before is when we have this realization event, right? A substantial change in ownership rights. And these events can come in a lot of names, but we normally think of them as a sale, exchange, or disposition. But things like condemnations, demolitions, abandonment, destruction, theft, all of these may also result in some sort of significant change in ownership rights. And so we need to see how these fit into the context of what we're doing. And of course, sometimes the sale, exchange, or disposition is purposeful. For example, you raise a building to build a new one. And sometimes it's not purposeful. It's involuntary. For example, if a hurricane destroys your building. Okay, so let's start with abandonment. So abandonment generally relates to business property, because obviously if an individual abandons a personal use asset, that's of no good to anyone because the loss is not deductible anyway. So, but if it's business property, that loss would be treated as ordinary. It must truly be abandoned, meaning you've left it behind, or it's going to be destroyed, or whatever the case might be. But you have left it behind and it's no longer within your control. And the fair market value simply isn't relevant with respect to an abandonment. We really just worry about the adjusted basis of the property that's been abandoned, because that's going to represent the loss amount, right? So we'd have amount realized 0, adjusted basis whatever, and that yields some form of loss that we would treat as ordinary. So the demolition of a structure is a little bit different. So in this instance, the loss is not recognized. And as a matter of fact, it's more like a wash sale. The loss isn't recognized, and then it becomes part of the basis of whatever is built or left. And there are a few special rules where certain modifications are not treated as a demolition. For example, if 75% of the walls remain. There's also special rules for historical structures, a little bit beyond the scope of this class, however. So U-Haul rents a truck to an individual, and that individual takes the truck over the southern border and into Mexico. And then the truck is abandoned by the renter. So it's just left somewhere on the side of the road in Mexico. And U-Haul determines that the cost to retrieve the truck is going to exceed both its value and its basis. And so as a result, U-Haul simply abandons the truck where it is. And at that time, the fair market value is $3,000. The adjusted basis is $1,500. Well, as a result of the abandonment, U-Haul simply takes an ordinary loss for the adjusted basis amount of $1,500. Okay. So let's say instead that Trump decides to tear down Trump Tower 1 and replace it with a new tower that we're going to call Trump Tower 2. So Trump Tower 1 has a fair market value of $1.2 million and an adjusted basis of $1.4 million at the time it's going to be torn down. And Trump 2 costs $11.6 million to build. So no loss will be recognized on the destruction of Trump 1. Instead, the adjusted basis of the land on which Trump 2 sits is increased by the adjusted basis of Trump Tower 1, which has been destroyed, which is $1.4 million. So as a result, the cost to, in addition, the cost to demolish Trump 1 is also added to the basis of the land. Okay. So now I want to talk about this special form of stock called Section 1244. And recall that we dealt with another type of special stock called 1202. And 1202 had to do with gains. 1244 has to do with losses. So Hannah sets up her business as a sole proprietorship. And she invests $30,000, but in spite of Hannah's best efforts, the business fails. And as a result, She takes an ordinary loss of $30,000. Montana, on the other hand, sets up his small business as a corporation and exchanges $30,000 for stock in the corporation, and then that business fails. Because stock is treated as a capital asset, Montana's going to take a $30,000 capital loss. So the problem is the capital loss is limited to $3,000 a year, presumably for up to 10 years if Montana doesn't recognize any other capital gains. So in order to create some equity so that small businesses wouldn't necessarily suffer loss limitations if they set themselves up as a corporation, the Congress wrote Section 1244. And again, it's a bit of a relationship with 1202. 1202 has to do with gains being tax exempt. 1244 has to do with losses being treated as ordinary losses. So, and when 1244 stock is sold at a loss, up to $50,000 or $100,000 if married filing joint of any loss on that stock can be treated as ordinary. And of course, any amount in excess of either the 50 or the 100,000 is treated as capital. So what does it require to be treated as 1244 stock, given that this is an advantageous situation? So it's designed for small businesses. So the stock is owned by an individual or partnership. It can't be owned by a corporation. It's originally issued to the individual or the partnership. So it can't have been bought on the secondary market. It has to have been issued at the time originally that stock was issued. It has to be issued by a U.S. corporation. It needs to be in exchange for cash or property, not for services provided by a shareholder. And the 1244 corporation must not be what's known as an investment corporation, which basically it just holds a bunch of investments as opposed to operating a business. And lastly, the small business cap is that the total contribution by everyone at the time of the formation of the corporation may not exceed $1 million. So again, it's built for small businesses. So Tyler, who's a single taxpayer, exchanges $150,000 of cash for 1244 stock in 2007. In 2018, he sells that stock for $30,000. As a result, he incurs a $120,000 loss. So because Tyler's single, he would get to treat $50,000 of that loss as ordinary, therefore it wouldn't be limited. However, that remaining $70,000 loss is long-term capital and would have to be bled out either $3,000 a year or offset any capital gains that are generated during each year subsequent. Okay, so I'm going to change gears entirely here. We're going to go through an area that is notoriously difficult. So for those of you that have been through Accounting 332, this should definitely be familiar. For those of you that have not, this is going to be a tough section. So what I would say is pay attention because it's not going to get any easier. So let's get started on this difficult part with a fairly difficult example. All right, so our friend Haley receives a $50,000 inheritance from her Grammy. And her friend Alex and she decide they're going to form a partnership. And the two of them both contribute $50,000, right? Haley contributes her inheritance, and Alex contributes $50,000 from who the heck knows where. And then their partnership goes out and buys a $1 million office building. Now, of course, to buy a $1 million office building when the partnership only has $100,000 of equity in cash, it needs to take out a mortgage. And then they hire a management company to run their office building. It's going to generate a rental income, but of course, it's also going to have depreciation deductions. And so even though this partnership has positive cash flow, it's actually going to throw off tax losses. So let's look at an example of what I'm talking about. So first, let's focus on the cash column, right? So rental income, $50,000, $15,000 of operating expenses. That's earnings before interest, taxes, depreciation and amortization of $35,000. Then it pays for the interest on the mortgage. and ends up with $5,000 of positive cash flow. If, however, we now look at the tax column, everything is the same except Haley and Alex's partnership is depreciating that building by $33,000 a year. And now recall, depreciation is a non-cash deduction, right? It costs you no cash to depreciate. And so as a result, they're showing a net loss of $28,000. I'm assuming a big old fat tax rate of 40%. So they're generating tax savings each year of $11,200 when they're actually making money. So the IRS does not like this plan. And it says, okay, wait a second. We're not going to let you throw off all these losses if in fact you're making money. So as a result, we're going to limit your losses to your basis, right? So let's think about what we know about basis so far. So far, what we know about basis is what is our investment in that property, right? So the two of them, recall, each invested $50,000. So we'd say, oh, all right, well, at least they're going to be limited to their $50,000 or each or $100,000 total of basis. But that is not how that works. Okay, so for sure they both did invest $50,000. However, they also took out a mortgage of $900,000 and created the liability. Now, what we're going to see is the way basis works is, let's imagine there are two scenarios by which this could have been done. And let's start with the one that did not occur, which is Haley and Alex went to the bank and said, hey, will you loan me $450,000 each or $900,000 total? The bank says yes. They turn around and invest that cash into the partnership. If they had done so, they clearly would have basis, right? Because now they will have invested another $450,000. So they'd both be in this thing for $500,000. Under scenario 2, what happens is instead the partnership borrows the $900,000. What that means is that Haley and Alex are on the hook for the $450,000 because as general partners of the partnership, they're on the hook for the partnership debts. So really there's no economic difference. And as a result, that basis is not affected by the choice to borrow to purchase property. As a result, Haley's basis is the full $500,000, which means, wow, she's going to have a lot of time to continue to deduct losses, right? Because she's going to be able to deduct them up to $500,000. Well, okay, so we've ruined this. Now we're back to square one. We've got this investment. It's throwing off losses. It's generating cash. How is the IRS going to shut it down? They need a better rule. So they came up with something that says, okay, look, we'll concede that the investment is basis, and we'll concede that the liability is basis. But what if the taxpayer really isn't liable for that debt? And recall that the terms that are used to describe this is something called recourse debt versus non-recourse debt. So in recourse debt, the bank can foreclose on the property and it has recourse against you individually to collect the debt. Whereas in non-recourse debt, the bank can foreclose on the property, but does not have recourse against you personally. So what that means is when a taxpayer is really liable for the debt, that's recourse debt. When they're not, when it's simply the asset that is secured by the debt, that's non-recourse debt. Using this information, we're going to create something called the at-risk amount. So the at-risk amount represents the amount of basis for which the taxpayer is truly at risk. So for example, if that building burns to the ground and is not insured against the risk of loss, well, clearly Haley is out her $50,000 that she's invested. But if the loan is non-recourse, which it probably is, that's her at-risk amount. Her losses stop at $50,000. That's why banks, mortgage companies insist you carry insurance on the properties that they're mortgaging, because if it burns to the ground, they want to be able to claim the insurance. So hopefully this is starting to make sense. There's only one problem. As we know, Congress loves real property. They just love real property. And so one of the things that the real estate lobby has done is they've created a category called qualified non-recourse financing. So non-recourse financing, recall, is financing that the individual is not liable for, unless it's qualified. So qualified non-recourse financing is generally non-recourse debt issued by a financial institution and collateralized by real property. And if it's qualified non-recourse financing, you treat that debt just like recourse debt. So in spite of our best efforts to pare back the amount of losses that Haley can take on her business, she is actually at $500,000 of at-risk amount. Now, this is a chart. It's not in your book. It's from a different textbook, but it's really great. And what you can see is how basis and the at-risk amount are affected by different items. And if you look at this chart, notice the one thing where they're different. Share of debt non-responsible to repay, that's non-recourse debt. Other, meaning it's not qualified. Notice that that is not included in the at-risk amount. However, just above it, qualified non-recourse financing, that is included in it. Okay, so we'll come back to this, well, actually we won't, but maybe a little bit later. But certainly if you haven't taken Accounting 332, you should have covered this topic anyway. All right. So before we move on to any more basis and at risk, I want to introduce a couple new characters. These new characters are Luke and Manny, and they just opened an organic food market. And Luke and Manny work there day and night. They are trying desperately to get this business to operate profitably. But invariably, like many new small businesses, like many startups, they're suffering losses in the first few years. Contrast that with, for example, Haley and Alex, that really largely put the bank's money to work, right? So they put $50,000 in each, but then they each borrowed $450,000 from the bank. So when you think about the $1 million asset at play with Haley and Alex, $900,000 of that is really the bank's asset. Whereas Luke and Manny, that's all their investment. They didn't borrow any money at all. So the tax code says, you know what? We don't want to penalize Luke and Manny, but we need some way to stem these revenue losses we get from people like Haley and Alex who are generating cash flow positive results but deducting these giant losses. So they had, since basis didn't do it and at risk didn't do it, they invented a new one, and that's called passive losses. So Luke and Manny are active investors. They are involved in the day-to-day operation of that business. Whereas Haley and Alex, they just hired a management company. They're passive investors. So the tax law uses a series of rules to differentiate between an active investor and a passive investor based on their level of participation. If you materially participate in that activity, you can claim it as active. Otherwise, it's treated as a passive activity. So here are the tests for material participation. I'm not going to make you memorize these. That would be crazy. But note that what they key off of, right? So number one, you participate more than 500 hours. Number two, your activity constitutes substantially all the participation in activity by anyone who's participating. So you can see that this is really built around how much work, how much effort are you putting towards this business? Because if it's material, then you get to treat it like it's active. Otherwise, it's passive. So big whoop, right? So, okay, we've got these two classifications. What difference does it make? The difference is passive losses are limited to the amount of passive income. So if you are a limited partner in a partnership, for example, you are considered to not materially participate. Generally speaking, you're verboten from making business decisions as a limited partner. So as a result, you're passive. Rental activities are deemed to be passive. So the tax code says, look, I don't care how much work you're doing. If it's a rental activity, we treat it as a passive activity. All right, now I think we finally caught up with Haley and Alex. All right, let's do an example. Lon. So Lon purchased an interest in a limited liability company for $20,000. His share of the debt in the LLC is $30,000. None of this debt is secured by real estate. Like a corporation, the limited liability company protects Lon from the LLC's creditors. Lon's share of the LLC's loss for the current year is $60,000. And what we're interested in is, Lon is clearly a passive investor. How much of that loss can he deduct? Okay, so the reason we walked through basis, at risk, and passive in that order is we have to apply these hurdles to Lon's passive investment. So first we need to figure out how much of that loss is limited by his basis. Then we figure out how much of that loss is limited by his at-risk amount. Okay, so what is Lon's basis? Well, it's what he invested, the $20,000, plus his share of the debt, or $30,000. So his basis is $50,000. So what this means is that under the basis limitation, he can deduct $50,000, so that's the extent of his basis, and the remaining $10,000 of that loss is what's described as suspended and must be carried forward. Okay, so suspended, well, I don't know why they use suspended here instead of carried forward, but the language is suspended. So 10,000 of the loss is suspended, 50,000 is carried forward. His at-risk amount is only 20,000. So note that this is an LLC. Lon, by definition, is not liable for the LLC's debts. As a result, he is not able to include that in his at-risk amount. So his at-risk amount is $20,000, what he truly invested, which means he can deduct only $20,000 under the at-risk limitation, and $30,000 is suspended. Note that's not $40,000, it's only $30,000, because only $50,000 cleared the tax basis hurdle. Okay, so just to be clear, the LLC generated a $60,000 loss that belonged to Lon. $10,000 was suspended under the basis rules, leaving only $50,000 available for at-risk. $30,000 was suspended under the at-risk rules, leaving only $20,000 to deduct. But we haven't considered the passive rules. If Lon is not a material participant and he has no other forms of passive income, then he is not eligible to deduct that loss, and the remaining $20,000 would be suspended under the passive loss limitations. So in summary, of his $60,000 loss, none of it is deducted. So you can see this is how the tax code shuts down Haley and Alex. Okay. So let's roll through some of these calculations, because I'm telling you, if you think you know what's going on, you probably don't, unless, again, you've already had 332. So the total loss is $60,000. So let's start with basis first. So we inject the $60,000 into the basis test. Basis at the beginning of the year was $50,000. Since we get to use $50,000 of that loss, we end the year with no basis. Generally speaking, you cannot have negative basis. As a result, that $10,000 loss is suspended. Now, the $50,000 is injected into the at-risk calculation. $50,000 at risk, it was $20,000 at the beginning of the year, therefore Lon can use $20,000. There's no at-risk amount at year end, and the remaining $30,000 is suspended. Then we inject the $20,000 loss into the passive income rules. Since there is no passive income, there's no passive deduction. Excuse me. And all of it is suspended. So at the end of the day, what do we deduct? Nothing. All $60,000 is suspended under each of these separate tests. Okay. So in addition to his interest in the LLC, it turns out Lon owns a rental property. And that rental property, which of course by default is treated as passive, produces $10,000 of rental income during the year. He also earns a salary of $60,000 from his employer. So now we've changed the situation a little bit. So how much of Lon's remaining $20,000 loss, after applying the basis and at-risk limitations, can he deduct? And the answer is he can offset $10,000 of his LLC losses with the $10,000 of rental income. So he actually nets to zero, but he uses $10,000 of that passive loss. The portion that he can't deduct, of course, is carried forward or suspended indefinitely or until he sells that passive activity. Okay, so let's relook at Lon's calculations under the new scenario. So you can see the total's the same, basis is the same, at risk is the same. However, the passive numbers have changed because now he generates passive income of $10,000. He can use $10,000 of loss. As a result, only $10,000 is suspended. So of his $60,000 loss, $10,000 is deducted and $50,000 is suspended under these rules. If in year 2, Lon decides to contribute $10,000 of cash to the LLC, and the LLC earns $40,000 of income. Okay, so if we look at the chart at the bottom, what I've done is all the items in red reflect the changes as a result of what happens in year 2. So you can see that contribution increases his basis and it increases his at-risk amount. And just like losses serve to reduce basis and reduce at-risk, they also serve to increase basis and increase at-risk when it's income. So the $40,000 of income increases basis and at-risk jointly. So now, after considering those two items, Lon's basis is back up to $50,000. So notice that he had suspended losses last year of $10,000. He can now deduct those against his basis. As a result, his end-of-year basis is down to $40,000. The $50,000 he creates minus the suspended loss leaves $40,000. So if we flip that up into the at-risk amount, so again, he finished last year with 0 at risk. He adds 50 to it at the beginning. He had 30,000 of suspended losses under the at-risk rules. He can now also include the 10,000 that was suspended under basis, but has now been released under the basis rules into the at-risk category. So he can deduct all 40,000 that's at risk. That leaves him 10,000 of his at-risk amount at year end. And no suspended losses under those rules. And then lastly, we flip that into the passive income. Now notice that the contribution has no effect on passive income, right? The only thing we offset passive losses with is passive income. However, the LLC generated $40,000 of income. As a result, he can deduct $40,000 of his losses that were suspended of $10,000 and the new deduction for losses that's coming through at risk. So now he's left with only $10,000 suspended at year end, and all $40,000 can be deducted. Okay, so let's summarize this one last time. So last year, Lon generated a $60,000 loss. He was unable to deduct any of that loss in the current year. Let me rephrase that. He was able to deduct $10,000 of that loss last year as a result of the $10,000 of passive income. This year, he's eligible to deduct $40,000 more of that loss. So he's up to $50,000 total, which leaves $10,000 suspended at the end of year 2. Okay, if you're totally confused, no surprise. As I said, this is one of the most difficult conceptual areas of the tax code. All right, now let's say at the end of the year, so after we've just considered everything we considered, Lon sells his interest in the LLC for $45,000. Okay, sale, exchange, or disposition. Amount realized, he should be selling it for $46,000, not $45,000. 46 up here. His adjusted basis is $40,000. Let's go back. We can see that. Remember, his adjusted basis at year end is $40,000. So his realized gain is $6,000. Is that gain passive? Well, remember, the rule said you can offset passive losses against any income when it's generated when the activity is disposed of. So we can deduct the suspended passive losses against the gain on the disposal and any excess losses against any other form of ordinary income. So when you depart from a passive activity, the general rule is you can go ahead and deduct those losses. So the suspended loss of 10,000, right? Let's go back and take a peek. So the suspended loss under the passive activity rules of 10,000, 6,000 of that is offset against the gain, and the remaining 4,000 is also deductible because he is out of the position. He has terminated his interest in that passive activity. All right. So that's great. I totally get these rules. Or maybe you do, maybe you don't. Let's talk about mom and pop. Mom and pop own a home they rent out to students at the local university. Pop approves new tenants, makes repairs when they're needed. Mom and pop's AGI before considering any income or loss from the rental property is only $50,000. However, in the current year, because they had a batch of bad tenants, their loss for the rental property for the current year is $16,000. So if mom and pop have no other sources of passive income, how much of that loss can they deduct currently? And of course, the answer is 0. So we need some exceptions, and there are 2 exceptions to these passive loss limitations that we just discussed. And I'm going to refer to one of them as the mom and pop exception and the other one as the real estate professional exception. So let's start with mom and pop, right? Because it's pretty clear that if mom and pop's AGI is only $50,000 and they incur a $16,000 loss, that truly could damage their ability to pay, right? And so as a result, if we know the tax code, vertical equity, is supposed to have at least some deference to ability to pay, maybe the IRS needs a rule so that when taxpayers really suffer a loss that hurts them financially, they can deduct that loss. So why don't we say we use a measure of income, right? We've done this before, right, with AGI. So more affluent rental property owners are capable of handling a bad year, but poor taxpayers are not. So we're going to draw the line in the sand, and we're going to draw that line at 100,000 of AGI. So that means a taxpayer with AGI over 100,000 gets no passive loss deduction. But a taxpayer with AGI less than 100,000 can take a passive loss deduction. However, the IRS cannot afford all losses, and frankly, if you're really not wealthy, there should be some limit to the amount of the loss you endure, or something funny's going on. So they decided to place an annual limit of $25,000. But wait another second, if your AGI is just $1 over 100,000, you get no loss deduction at all? Of course not. It's phased out, right? So we've dealt with some phase outs prior to this. This is another one, right? So in order not to fall off that cliff just because your income is $1 higher, there's a phase out on that $25,000 annual limit. So what happens is for every dollar a taxpayer's AGI is over 100,000, the $25,000 limit is reduced by 50 cents. So let's start with mom and pop. Their AGI was 50,000, their rental loss was 16,000. Since their AGI is below the threshold, mom and pop could deduct up to 25,000. Since their actual loss is 16,000, that's the amount they're going to deduct. What if mom and pop's AGI was 110,000 instead? Well, now they're over the $100,000 threshold by 10,000. 50 cents on every dollar over is 5,000, so they're going to reduce the $25,000 limit by 5,000. That's down to 20,000, but that still means that mom and pop can deduct their entire $16,000 loss. What if mom and pop's AGI is 140,000? Well, now they're 40,000 over the threshold. 50% of that is 20,000, so they reduce the $25,000 limit by 20,000, bringing their limit down to 5,000. That means mom and pop could only deduct 5,000 of that passive loss. The remaining 11,000 is going to have to be carried over. If mom and pop's AGI is 150,000, well, now they're 50,000 over. Multiplied by 50% is 25,000. Therefore, they have completely phased out of their ability to use this exception to the passive loss limitation rules. The second exception. Okay, so remember how Luke and Manny were not subject to passive loss because they were active participants. In fact, they were material participants in their activity. What if your business is rental real estate? So real property business such as development, redevelopment, construction, reconstruction, acquisition, conversion, rental operation, management, leasing, or brokering of real property. If in fact that is your business, you must have one half of personal services are in the real property business, and you spend more than 750 hours a year in that business. And by the way, hours as an employee do not count unless you're a 5% or greater owner. Then you can elect to treat that as a true business, and therefore it is accepted from the passive loss limitation rules. Okay, let's leave passive losses behind and discuss casualty and theft losses. So this is an area that had some pretty substantial changes with the new Tax Act. For businesses, it's not a big deal because business losses are generally deductible anyway. So this is a situation, so we've been living by this rule. Remember our ground rules. Personal losses aren't deductible. However, they are deductible in certain circumstances if they qualify as a casualty. So this idea of a casualty loss, casualty or theft loss, is different than just a typical loss. So a casualty is a sudden, unexpected, or unusual loss. Starting in 2018, a personal casualty loss must be associated with a federally declared disaster. If you have a loss, it's associated with federally declared disaster. First, you have to apply a $100 floor, and then you apply a 10% of AGI floor. So you can imagine the $100 floor gets rid of really small losses, real nuisance losses. And the 10% of AGI is another, like, make sure that it has an ability to pay element to it, right? If the loss is fairly small, then taxpayers should just simply be able to absorb it. So what we're after are more catastrophic type losses. So Macy's car was destroyed in a federally declared disaster. So let's say a hurricane, a tree fell on top of it and destroyed the car. Her loss was $16,000. Her AGI was $67,000. So the first thing we do is take the $100 floor away. So her loss is limited now to $15,900. On top of that, she has to back out 10% of her AGI. So that means you take the $15,900 minus the 67 times 10%, and you end up with a deductible loss of only $9,200. So this is an itemized deduction. If Macy does not itemize, the loss isn't even relevant, right? So now with the larger standard deductions amounts and the restriction that it has to be a federally declared disaster, the amount and number of casualty losses for individuals has been limited severely. Okay, so there's a special kind, or there was a special kind, we don't know if there'll be any more. There was a special kind of federally declared disaster described as a qualified federally declared disaster. And the reason I bring this up is you're going to see it inside the 4684 that you use to file a casualty loss. So Congress took action on 3 disasters in 2017, and it actually increased the casualty loss benefit. And it did that for 2 of the hurricanes and the California wildfires that took place in the Napa area. So far we've got nothing for the California wildfires that took place up in the San Bernardino area. Santa Barbara area. So nothing for those yet, and probably nothing coming because it's been a while. So if it was one of these qualified federally declared disasters, the floor was increased from 100 to 500, right? So the amount had to be larger, but it got rid of the 10% AGI floor. And more importantly, you could include it as part of your standard deduction. So this was a significant expansion of the casualty loss rules for individuals because it permitted them no AGI floor and to take that loss whether they itemized or not. So Macy's car was destroyed in a qualified federally declared disaster area. Her loss was 16, her AGI was 67. In this case, she would take all 15,500 as her deductible loss, and it wouldn't matter whether she itemized or not. Okay, so far in 2018, we had a couple of pretty serious hurricanes. Recall, one was in North Carolina, one was down in the Florida Panhandle. Congress took no action in 2018. Since we are deep into the 2018 filing season, it would appear that no action is going to be taken. And so although they are federally declared disasters, they are not qualified disasters. So as a result, the 110% AGI rules apply to those. Okay, so how do you define the amount of your casualty loss? And the rules differ between business and personal losses. So if it's complete destruction, if it's business, it's just the basis. If it's a personal item, then it's the lesser of the fair market value or the basis. If it's partial destruction, then for both business and personal, it's the lesser of the decline in the fair market value or the basis. So there are also some weird rules associated with casualty losses. For example, even under the current rules, if you generate a casualty gain, you can offset that with your personal casualty losses, even if they're not federally declared disaster losses. Casualty gains are not subject to any 10% or 10% AGI, right? Typical of what we've learned, they kind of make you always include the gains. And of course, any insurance reimbursement that you receive reduces the amount of loss. In certain instances, with certain federally declared disasters, they actually allow you to amend your prior year return. And the reason is, let's say it's late 2018 and you suffered a hurricane, the one in Florida. Well, you could wait until you filed your 2018 taxes about now, or they would actually let you amend your 2017 tax return, and as a result, you'd go ahead and get that immediate refund, right? So you'd file a amended tax return and get your refund right away. So the idea is to get you the cash that you presumably need right away, again, under ability to pay, right? So the IRS isn't all so bad. All right, our next area is bad debts. So bad debts, we're going to focus on a cash basis taxpayer. And that's largely because this class is about individuals and the likelihood of it being accrual is much lower, but we'll touch on that anyway. So a cash basis taxpayer can't have bad debt from accounts receivable because they don't have basis in accounts receivable, because they're cash basis, they don't recognize accounts receivable, right? It's not income until it's constructively received. There must be a bona fide debtor-creditor relationship. So individual taxpayers often loan money to related parties. Those related parties create all sorts of issues, right? So if I loan my son money and then later on I decide that he's never going to pay it back, and so I forgive it, was that a bona fide debt, or am I just giving him a gift? Right? And the same is true with investments in businesses, right? So if I'm 100% owner of a corporation, the corporation owes me money and I forgive it, am I really just making an equity contribution? So you always need to be careful with the bona fides related to a related party transaction with respect to bad debts. So non-business bad debts are treated as a short-term capital loss. Boom, period. Right? So it doesn't matter how long it's been a bad debt. It doesn't matter whether it's treated as a capital asset or not. Non-business bad debts are treated as a short-term capital loss. These are not partially deductible, meaning you may not take a bad debt deduction until the entire debt becomes worthless. Business debts, on the other hand, you treat as an ordinary loss, and you may deduct those when they are partially worthless. So if you think you're only going to collect 40 cents on the dollar, you can write off the accounts receivable down to the 40 cents on the dollar and deduct the other portion as bad debt. It is very hard to get business debt treatment for individuals. So, for example, let's say Joan loans Betty $10,000 to start Betty's new business. Well, you would think that would be a business loan. But if Betty's business fails, Joan's loan is treated as non-business. Basically, for an individual to get business debt treatment, they really have to be in the business of loaning money. And since that's largely within the purview of banks within this country, it's very difficult for an individual to get that treatment. All right. The last area we're going to deal with, at least I think it's the last area, is something called net operating losses, right? And hopefully, again, you covered this if you've had 332. But the idea is when you incur a really bad year, in fact, so bad that you don't have taxable income, you have a taxable loss, you should be able to capture that amount, not pay any tax, and carry it forward to a subsequent year when you do generate income. So the tax law is designed to permit individuals to deduct business NOLs and to prevent the deduction of non-business net operating losses. So what happens is you have to go through the items of income deductions, gains, and losses and classify those as either business or non-business related. So what that means is the NOL simply wouldn't be the taxable loss, if any, shown on page 2 of the Form 1040. Okay. So the first thing is you can't include a deduction for an NOL from a previous year. The next thing you do is you determine what are your non-business capital losses. So those are the ones that arise outside of a trade or business or employment, and those can only be used against non-business capital gains. Any excess non-business capital losses can't increase an individual's NOL. Nextly, your non-business deductions, which are items like charitable donations, your medical expenses, mortgage interest, alimony, these can only be used against non-business income. For example, portfolio income like interest, dividends, etc. However, if from step 1 your non-business capital gains exceed your non-business capital losses, then the excess deductions can be offset against those gains. And note that casualty losses are treated as business deductions for NOL purposes, even though they clearly can be a personal casualty loss. You treat them as a business loss. All right, business capital losses can only be used against business capital gains, except they can also be used to offset a non-business capital gain if one exists. All right, so let's do an example because this is just another perplexing area of the tax code. So you, John, a single taxpayer, has completed her 2018 Schedule C and her net loss is $70,000. She also generated $45,000 and has interest income of $500. Her business sold property during the year generated a $3,000 ordinary gain and a separate $5,000 long-term capital gain. You, John, also has several capital gains and losses from the sale of stock investments. The net result is a $17,000 short-term capital gain and a $6,000 long-term capital loss from the sale of these stocks. She itemizes her deductions, and her Schedule A has taxes paid of $8,500, mortgage interest of $6,000, charitable gifts of $500, and a casualty loss in a federal disaster area of $2,500. That means her total itemized deductions are $17,500. All right, so let's first calculate her taxable income. So we take her wages of $45,000. We add the interest income. Then we deduct her business loss off her Schedule C of $70,000. Then we would include her capital gains. So that's her net capital gains, both business and non-business. That totals to $16,000. We add the $3,000 of other gains and we get her AGI. Then we take her 4 AGI deductions, which are her itemized deductions. We end up with a taxable loss of $23,000. But recall the rules say you don't simply take that amount and treat it as NOL. Instead, we have to bifurcate each amount into its business and non-business portions. So you can see I've done that in the table on the right-hand side. So wages are treated as business, whereas interest income on her personal savings account, that's non-business. Of course, the business loss is business. I put her business capital gains under that classification and her non-business capital gains, net, under the non-business classification. Her ordinary gains were related to the business. And her itemized deductions, recall that $2,500 was a casualty loss. We treat that as business, whereas all the rest is treated as non-business. So you can see we've taken the $23,000 of taxable loss and split it into the two parts, $19,500 for business, $3,500 for non-business. So now we would analyze that and say, okay, does my non-business capital loss exceed my non-business capital gain? And in this case, it doesn't. In fact, we ended up with a non-business capital gain. Non-business deductions can't exceed non-business income. So as a result of that $15,000, we can only use $500 of that amount. So that would bring us down to $14,500. However, we can use the non-business capital gains to absorb those additional deductions. So $11,000 of that ends up being absorbed, and we end up with a $3,500 non-business loss. That amount is added back, and we get the business loss, which we had calculated anyway, as $19,500. Okay, Fujian, everything is the same, except she has a $1,000 short-term capital gain and a $7,000 long-term capital loss from her non-business stock sales. Everything else is the same. All right, so we would calculate her taxable income as follows. So the same wages, the same interest income, the same business loss, but her net capital gains, both business and non-business, are now a loss. The other gains are the same. Her AGI is a loss of $22,500, less the itemized deductions. Her total taxable loss is $40,000. We now know that we need to take the $40,000, bifurcate it into its two pieces. If we bifurcate everything into the business column, we put everything into the non-business column. What we see is we take the non-business, we add it back to the loss, and we get an NOL of $19,500, which is in fact what we classified as our business loss anyway. All right, so a few more things related to the NOL. The first is, in the rules prior to 2018, you were eligible to carry back an NOL for 2 years, and then you carried it forward for 20 years. You could also simply make an election to carry it forward for 20 years. So what would happen is if you didn't use that NOL in the next 20 years, it simply expired. Starting in 2018, NOLs can only be carried forward, and they can only offset up to 80% of the future income in any year. But at least on the good news is they can be carried forward indefinitely, so there's no more 20-year expiration. So in 2018, Rusty generates a net operating loss of $10,000. In 2019, he generates taxable income of $12,000. So he can use 80% of his 2019 taxable income, which is $12,000 times 80%, or $9,600. The remaining $400, the remaining $400 is carried forward and can be carried forward indefinitely. So presumably when Rusty makes income in 2020, he'll be able to offset up to 80% of that as well and absorb the $400 and therefore reduce his taxable liability for those future years. All right, that brings us to the end of Module 8. Thanks for listening.